Hello, and welcome to FEI's Private Companies webinar series, BMO Middle Market M&A 2021 Outlook. Thank you for joining us today. Before we get started, we'd like to share some information regarding CPE credits with you, and we appreciate your patience. Today's session is worth 1 continuing professional education credit. Please be sure to enable your media player to hear audio. To be eligible for CPE credit, you must have a total viewing time of at least 50 minutes and respond to a minimum of 3 attendance checks throughout the webinar. These will appear on your screen along with the audio cue. If the attendance check requirements are met, participants will have the opportunity to download their CPE certificate immediately following the webinar. In accordance with the standard for the National Registry of CPE sponsors, CPE credit will be granted based on a 50-minute hour. We are unable to grant CPE credit in cases where technical difficulties disqualify eligibility. CPE program sponsorship guidelines prohibit issuing credit to those not verified by the technology to have satisfied the minimum requirements listed above. After the presentation, this webinar will be available on the FEI site for replay and download. Please feel free to ask questions throughout the presentation, and the speakers will answer as many as possible. Now it's our pleasure to introduce Joe Hellman from Redpath and Company. Joe?
Thank you, and thank you all for joining us for today's webinar. I'm Joe Hellman, the Transaction Advisory Services Practice Lead at Redpath and Company. I'm joined by Ben Marks from BMO Capital Markets. Before I let Ben give an intro of himself, I wanted to encourage everyone to ask questions live.
Sounds good. Well, just quick background. My name is Ben Marks, and as Joe mentioned, I'm a managing director in BMO's Middle Market M&A Group. I'm based in Minneapolis, Minnesota. I lead our firm's efforts in the specialty industrials segment. My practice is very focused on advising family and entrepreneur-owned sellers of businesses. I started my career at Citigroup in New York, and I'm an alumni of Boston College. Joe, are you back on? Do you want to give a little more background on yourself?
Yeah, sure, Ben. Hopefully it comes through this time.
No worries.
Okay. So I'm the Transaction Advisory Services Practice Lead at Redpath and Company. Started my career doing traditional audit and moved into consulting about 7 years ago. So I've been working on M&A for the last 7 years, and I'll turn over to Ben to let him kind of give the rundown of what we're going to be covering today, as well as to get started. But we'd really encourage everyone to ask questions throughout, make sure that we can answer as many as we can in the allotted time. If not, we're more than happy to have follow-up conversations.
Perfect. That sounds great. So I know the topic overall today is more focused on 2020, and I assure you we will get to that and what the outlook is. We thought as a starting point, it might make sense to unpack what the high-level observations were from 2020, which was certainly a very interesting year, both for the world, for our economy, and for M&A, but then talk about things from a micro perspective and what we're seeing both in terms of buy-side observations and sell-side observations. We'll go into some detail on what we're seeing in our own practice, too, with some of our live engagements. So the macro, 2020 was a year for the history books, so to speak. As the slide says, it was truly a tale of two halves. 2020, the first half was marked by the steepest decline in M&A volumes and value ever. M&A essentially ground to a halt in the second quarter of 2020. Highlighted by liquidity concerns for both private equity-owned businesses, corporate businesses, and private companies. The financing markets as well, which are used to support transactions, effectively were frozen from the middle of March through the end of June. That was followed sequentially by the strongest second half year-over-year performance in history. The second half of 20 had 58% increased transaction value for M&A than the second half of 2019, which is absolutely incredible. Large swaths of the economy were largely unaffected or even positively affected. You saw certain sectors like technology have absolutely record amounts of M&A, while others remain significantly depressed. Interestingly, when you unpack, the deals that happened last year, we did not see much volume in the way of distressed deals. In our experience, the very significant majority of transactions completed in 2020 were deals that involved healthy sellers and healthy buyers at healthy valuations. So I'll go into just a little bit more detail on 2020 here. So here on the top half of the page, it shows a chart both in terms of deal value and the number of transactions completed. When you look at the year overall, not just first half, second half, the year ended down about 20%, both in terms of the number of deals completed and the deal value. Interestingly, this was a far less sharp contraction than we saw, about 10 years ago. So 2020 ended up being down, but not as much as I think we would have expected earlier in the year. When you really look at what happened, in each of the quarters in the bottom half of the page, which shows effectively the year-over-year comparison in M&A volume and values, you saw that the first quarter of the year started relatively flat relative to the first quarter of 2019. And there was significant optimism from myself and others in our sector. Obviously, the second quarter of 2020, we saw virtually all transactions going on hold. The only transactions that were completed in the second quarter of 2020 were ones that had been previously announced or ones that were highly strategic. For myself personally, the only deal that got done, probably not surprisingly, was a manufacturer of cleaning chemicals. In the third quarter, we started seeing the green shoots of a recovery. Many businesses that had been insulated from the COVID-19 pandemic or ones who'd seen positive impacts retested the market, and most of them actually got completed. And then the fourth quarter saw an extremely strong push to get deals done by year end, particularly with private company counterparties on the heels of the presidential election, trying to make sure they locked in those taxes, so to speak.
And Ben, when I think about what I had read a lot of, we had a lot of processes that went on pause, and December 20 ended up being one of the best months in history. And if you read further into it, particularly the last 2 weeks of the year, it seems like there was a lot of impact due to the change in administration. Is there anything else that you can think of that you saw or that drove that besides that change?
It's a really good question, Joe. I think ultimately it really did come down to tax policy being the primary motivation to get deals done at year end. We saw the same thing 8 years ago at the end of 2012 when some tax changes were going into effect at that point in time. Taxes were certainly a motivator for both parties to get deals done. I do believe that was the primary motivation.
Correct. And then we did have a question come in just to confirm that this isn't just middle market. This is all M&A volume that we're looking at in this chart.
That's exactly right. Yeah, this is the M&A. This is the U.S. M&A activity overall, not just middle market. So it does encompass both larger transactions and smaller transactions. That's right. So let's go a step further. We've talked about the U.S. M&A market conditions in 2020 at a high level. Let's go just a layer deeper. And the way we think about it are, what are corporate clients doing, meaning large public and private companies who are both buyers and sellers of businesses? What are private equity groups doing with respect to buying businesses and selling businesses? And then what are we seeing in our own business with respect to trends in private company sales? So first, I'll talk a little bit about corporates in terms of what they're doing from a sell side. I remember when I first started my career in investment banking about 15 years ago, the word divestiture was a very dirty word, so to speak. It connoted underperforming business units, lots of complexity, not a good word. Now it's evolved into something more positive. And investors, both in public and private companies, are being rewarded for active portfolio management. So undergoing reviews on a regular cadence of which products, which markets, which businesses make sense to invest in or divest over time. We're seeing in our business a huge number of both public and large private companies explore divestitures for the first time. This is partially the result for public companies of increased activist activity, really pressuring management teams to think very hard about what businesses fit and which don't within their core. We're also seeing, from a carve-out perspective, increased creativity with respect to scope. So when you think about a divestiture, historically, it was, it's just a business unit. It's relatively standalone. We're seeing clients get very creative with respect to carving out specific product lines or facilities or end markets for products. On the flip side, the demand for corporate carve-outs has gone up. We are seeing many of our corporate clients being solicited for carve-outs basically on an unsolicited basis. And that's not only by strategics, but also by, private equity funds who are now, now willing to look at carve-outs, not only as bolt-ons to their existing platforms, but also standalone investments. Just an example of that was we worked with Ecolab, which is a very large chemicals company, on the sale of their equipment care business. It was a services business in a very highly fragmented market, huge roll-up potential, and ultimately a private equity firm bought the business, not only because of the consolidation potential, but because it came with a Fortune 500 pedigree management team. So we've seen a huge uptick in our business of this type of activity. Joe, maybe you could comment a little bit on what you're seeing in terms of your own corporate clients on the buy side and how aggressive they've been.
Yeah, thanks for that. It's been interesting. I think in the past, you didn't really see much for strategic rushing to the front of the process. Typically, those processes took longer. It was harder for them to get their shareholders comfortable looking at deals, as well as really getting the board approval to be able to pursue some of these matters. So when I think through the timeline, it's always been longer. And what I'm seeing right now is there's much more of a sprint to the front where people are willing to pay extra and get ahead, get to exclusivity, to really dig in. Where we hadn't seen investment being made in the past, we're now seeing corporates put investment into it, getting diligence providers engaged earlier. And I think one thing that really resonates with me is through certain CDO or corporate development surveys that have been done out there, it shows you the value of relationships and how 62% of the most recent one I read was that those are all sourced through relationship versus the broad auction process. So it really kind of shows you they're getting out there more. They're willing to invest in it while also still cultivating those relationships.
Yeah, I've also seen many, I'm sure you've seen this too, Joe. I've seen many small and mid-cap public companies hire corporate development folks for the first time, as they actually really look to build out the function within their own organization.
Yeah,
I totally agree.
What do you see from a valuation perspective as far as, strategic versus sponsor backed? I know we'll get more into that later on, but just curious on what you're seeing there.
Yeah, it's a good question. It's situation specific. In certain industries and certain circumstances, we have seen, in terms of corporates, very focused on bidding off of, contribution profit to the extent you're selling, a product line or something like that. So we certainly see them effectively pay for synergies. On the private equity side, we've seen private equity groups really aggressively pursue platform investments and really push the bounds on leverage. We'll talk a little bit about where the debt markets are today, but they're back to where they were for most industries. They're back to where they were pre-pandemic. So the debt markets are very supportive of private equity transactions in this environment.
Okay. And for when we're thinking through the assets and the multiples there, are you seeing more being driven for IP or more of the hard assets?
It really it depends on the situation, but we're definitely seeing folks bid aggressively on businesses, for both those reasons. Yeah, it's kind of hard to bifurcate between both.
Okay, thank you.
Mm-hmm. So a little bit about private equity. Interestingly, at least in our own business, we saw private equity sales take somewhat of a pullback, just in terms of the number of private equity groups exploring sales of their portfolio companies last year. That said, the private equity owned businesses that we represented last year went for very large multiples in very narrow auctions, in what I like to call, early monetizations or market checks. These tended to be businesses that performed very well throughout COVID or did not have much impact as a result of the pandemic. These were businesses that had been approached on an unsolicited basis by, strategics or other larger private equity funds. And in some cases, these private equity groups really wanted to use these monetizations to help them raise, their next fund to pursue opportunities. Private equity is, as you might expect, they're very disciplined. They're very focused on both IRR and cash on cash return. So they're not going to sell, or they don't have motivation to sell their portfolio companies until the timing is actually right to maximize those returns. We expect that, at least for this year, the businesses that they'll be looking to sell are ones that are, home run type investments. The ones that had, significant COVID impact, I would not expect them to look to sell those for the next 12 or 24 months until they understand what the post-pandemic market looks like. The last thing I'd mention with respect to private equity is they continue to very aggressively fundraise in this market. That's not only large funds, but that's very small funds and new funds as well. And the amount of undeployed capital or dry powder is at an all-time high, nearly $750 million in equity capital, which translates to about $1.5 trillion worth of buying power, factoring in leverage.
Thanks, Ben. And to speak a little bit to buy-side trends that we're seeing here, one thing that I think is quite astonishing is the fact that add-on activity continues to skew all the numbers when we look at counts. When we look back in the last 12 months, it was about 72% for FY20. Compare that to prior periods, we're talking upper 60s. So we continue to see the add-on activity become more and more popular. This just speaks to the value of the platforms. You find the platforms, the private equity have been willing to overpay for that. And then the add-ons, they're going to do those very quickly. And hold periods for those could be similar to what they've been, where you always think traditional timeframes, or they may be quicker. I'm working with one right now that they may be looking at 18 to 24 months because they're able to bolt on so many acquisitions. So I think it's been very interesting in that grand scheme. While at the same time, we're also seeing them kind of expedite the process a bit, where they're willing to do a little bit less from a diligence perspective and take a little more risk on these smaller add-ons. So it helps them close much quicker. So I think just whether it's the last month of the year, because everyone was trying to get deals done, it'll be interesting to see how things play out as we get into 2021 here, to see if some of those trends continue or if it gets back to some of the traditional process timelines.
Those are good observations. The other thing I failed to mention, we're seeing this a lot with private equity on the buy side, is they're spending a lot more time doing their own desktop research or conducting their own due diligence. So kind of putting together, their own internal white papers on, this is an industry we really like, or this is the profile of the company we really like, and proactively going out there and seeking it out. They're not just sitting around their computers or their phone waiting for someone like me to give them a call. They're being very, very overt in the way that they're going after, businesses or specific industries.
Yeah, I think you're exactly right. The number of proprietary deals I've seen come across my table at this point from add-ons, it just shows how active they are in the market and how much that value of relationship and the founders of some of these businesses, how much of a difference it really makes.
Yeah, absolutely. So lastly, we thought it would be helpful to give you some insight into what we saw in 2020 in our own business. So before we talk about kind of the output of the data, it's probably helpful to give you some ideas on what the inputs are, meaning kind of what the data represents. So we looked at about the last 125 deals, so about the last 3 or 4 years worth of transactions that our team has done. Again, very focused on closely held businesses across diversified industries like industrials, tech and business services, food, consumer retail, and healthcare. And the average deal size is around $100 million. So this really reflects what we're going to go through, kind of the aggregated output of that information, but you can glean some pretty interesting insights into what's going on in the market. So very high level, process health check, as I like to call it, starting at the very top in the left-hand side. Last year, if you were to look at, the deals that were completed versus failed or went on hold, about 65% of the deals we had mandated actually did get done successfully, versus about 35% went on hold. If I was to rewind back to April and you were to ask me what this would look like at the end of the year, I think it would have been far more in the failed or on hold category. But again, I think the year ended up pretty solid. That said, if you were to benchmark it against what this looked like back in 2019. In 2019, this was about an 80-20 split. So obviously we saw a significantly higher number of transactions, either fail or go on hold. And in part because COVID had some very specific impacts on certain sectors. Where did we see pain in 2020? Specific industries, some of these are probably not very surprising: travel and hospitality, real estate, restaurants and food service, retail. It's not on here, but energy as well. What I find very interesting about this is that it is so much different than areas where we saw challenge in prior years. If you were to look at what were the perennial industries that would be on kind of the failed deals list, it would be things like automotive, consumer discretionary, building products. And what's interesting is many of those industries actually did very well through the pandemic. We successfully sold a boat business and a building products company in the midst of COVID. Businesses that I think inherently have the stigma of being recession prone actually did relatively well throughout the pandemic. So I'd point that out. The bottom half of the page probably takes a little bit of unpacking, but it gives you some insight into what our processes have actually looked like. So in the bottom left-hand side of the page, this effectively maps out from 2018 to 2019 to 2020, what the level of engagement was in our sale processes in terms of what was the average number of initial bids we got, what was the average number of management presentations or site visits that we conducted, albeit virtual in most cases, and what was the average number of letters of intent or final offers that we received. Very interestingly, after many years of seeing sequential increases in the number of initial bids and management presentations and letters of intent, we saw a very, very sharp pullback in terms of the number of initial bids, from 12 on average in 2019 to 6, from 7 management presentations on average in 2019 to 3, and 4 final bids on average to just 2 in 2020. And it's really the result of much narrower processes being conducted in 2020. More than 50% of our deals that were completed in 2020 involved outreach to less than 10 buyers. Now, you might be asking yourself, why would you ever do that? I think it comes down to 3 trends that I expect to continue going forward. One is we hit on before, both strategic corporates and private equity are becoming much more aggressive in terms of defining the types of assets or industries that they're in and making outreach proactive to start a discussion. The second is that many of our private company clients have raised expectations on what they expect their banker to know. So it's not just, okay, you're going to use the same phone book and call the same 1,000 buyers, on this deal or that deal. They actually expect you to know, who are the top 10 or 20 private equity firms who like healthcare services or whatever the industry is. And then lastly, there's just heightened concern about confidential information, particularly in an environment where so much is uncertain with respect to the outlook of their businesses. So I think that we'll certainly continue to see those 3 factors play a big part in, whether our clients choose to go more narrowly or go more broadly with respect to outreach in our deals. Just quickly on the bottom right, this is just a dispersion chart showing kind of the average number of bids that we got on deals. So again, 64% of our deals last year had 0 to 5. So somewhere between 0 and 5 initial indications of interest. That's down significantly from the prior year. And we had no deals last year that had more than 15 bids. So gone are the days of getting 30 or 40 indications of interest on deals. Joe, anything you want to ask?
Yeah, the one question I have with this is, are you, with the disruption in your traditional auction process, do you see that changing forever? Do you see kind of going back to how it was before, or do you see some sort of a hybrid between the two of them, being that you have been effective in this way?
I think you've really got to, read and react. For businesses that, are inherently, really, attractive companies, and your banker or advisors have got to make that determination. In places where you've got, lots of inbound interest, there's at least a case to be made that going more narrowly will allow you to spend more time and effort actually cultivating that early interest and focusing on those buyers. That said, there's a lot of businesses that don't lend themselves, well to these types of, narrow auctions in industries that have, particular, stigma, or businesses that have had very volatile financial performance over the last several years. I think that the broad process will always have a place. I just think that if you look at it over time, folks will, I think what we've learned through the recession is that there's more than one play in the playbook, so to speak. You don't just have to conduct things in kind of this cookie cutter type mold. And I think you can still get deals done and done very successfully without going extremely broad.
And what are you seeing from the COVID impact? I think one thing I'm asked all the time is, what are you doing for adjustments right now? Like, everyone wants to know that question, whether you've been impacted positively, negatively, not at all. What are you seeing there?
It's a great question. And very honestly, we have not brought to market many businesses that have been very severely affected by COVID-19. We've counseled clients who've experienced really significant impacts from COVID-19 to wait until the baseline's been established, so to speak, or you're on the upward trajectory. Many businesses are still in the trough, so to speak, and it's very hard to validate what an adjustment looks like until you know what the world is going to evolve back into. On the flip side, I will say we are getting scrutiny from many buyers. Not surprisingly, many of our clients have seen positive impacts from COVID, so we're spending a whole bunch of time educating buyers on why changes in consumer behavior or product purchase trends that resulted from COVID to the benefit of our clients are sustainable. So very honestly, in deals right now, we're actually trying to justify positive impacts to COVID more than negative impacts and positive adjustments, if that makes sense, Joe. I'm curious what you're seeing, if you're seeing many of these businesses that have been adversely affected, really wanting to test the market.
I've been involved with the process where people are trying to get really aggressive with it, both on buy and sell side. At the same time, I tend to be on the more conservative side with this. Similar to what you said, until I have a baseline to see how the company's been impacted, I want to see what changes have been made, because for every dollar that's been lost, there's likely been an impact to the expense of some sort. Most companies, if not all, have made some sort of operating change that's going to have an impact to run rate expenses. So for me, I've been really kind of looking at the business, kind of going month by month, period over period, but really trying to get a better feel for, now that we're getting close to a year into this, trying to get an idea of what's the business look like right now, and how does management think that they're going to play out? Do they think they're getting close to what normal would look like now? But I agree. I tend to be on the conservative side, where I'm not putting adjustments in there just because we don't know yet how these companies are going to look.
Yeah, I've seen in our clients, I've seen far fewer COVID related adjustments than I thought I would have ever experienced 6 months ago.
What have you seen from an impact, the actual multiple that a business is getting with COVID? You talk about you've had to defend some of the positives right now. In those cases where, at one point early on, there was a discussion of the COVID premium for the companies that have stayed healthy through all this. What are you seeing there?
It's a great question. With respect to the positive COVID impacts, I mean, it's requiring us to do a lot more work with respect to validating customer product specific consumption trends. Obviously the buyers are having to spend a lot more time doing very up-to-date market studies of what's going on in particular industries, and also relying very heavily on customer reference checks at the right time. But at the end of the day, I continue to see really good businesses going for extremely high prices, premiums, and then things that are kind of B or C are either not going to market, or if they're going to market, they're getting, at or less than what they had expected. It's almost a tale of two cities.
Yeah, I think that's consistent with what I've seen as far as when I've been advising also, is that your A assets right now, they're trading for some, frankly, some crazy premiums. We did have a question come in here. Do you see any trends related to less due diligence occurring during this period due to the transparency and how much has moved to being digital? I'll let you take the first stab at that, and I can give my thoughts as well.
I would say yes. I think in part it's because of the technology. I think we're figuring out how to make due diligence, work remotely. And I do think we are seeing, folks become more aggressive and more selective in how they conduct, due diligence. I would say that it's less about COVID, and I think it's more about competition, frankly. Joe, I'm sure you're seeing or being put in situations where, firms are calling you up and saying, hey, can we get a due diligence report done, next week? Because we've got to, get in front of the process, so to speak. But I think it's less driven by COVID and more driven just by the relative competition for really high quality businesses and forcing them to be selective.
Yeah, I'd agree with that, because even when I think through how everything's moving to digital right now, as much as it took a little bit for us all to adjust to virtual management meetings, we're all getting used to the video component of it. So, whether it's 90 to 95%, but that's all what you usually would read in body language, right? For verbal communication versus visual. And we found ways to be effective in that. But this big challenge for all of us is we still have data that's a train wreck at times, right? As much as everything's moving to digital, I get into deals, and there's a lot of them where you're only as good as what your systems can produce or how good you've been at monitoring your business. So what we're seeing is, despite the move to digital, there's still a need for the diligence aspects, but I'm being asked a lot of times to really skinny the scopes, really focus on certain matters to make it so we can get done in a couple of weeks.
Yeah, the last thing I would say is we're getting very creative with respect to how to do due diligence. On at least one of the deals I'm working on, we actually hired someone to make a drone video of like a facility tour in place of actually allowing people to be on site, which was pretty cool and a good way to short circuit some due diligence and get folks comfortable. I still am incredibly impressed at how many deals are getting done virtually and without almost any sort of in-person interaction. It's shocking. I don't think it replaces it, and I certainly hope we'll go back to at least some human interaction in person, but I'm impressed with how our industry's adapted.
I agree. You talked a little bit about industries. Are there specific regions that you're seeing that are hotter than others?
I got to tell you, I've not dissected, our information in that way, but that's a really, good question. I've seen, some geographies, I think, be, relatively less affected, from a COVID perspective. I was working on several deals in the Northeast, which had some very severe lockdowns, earlier this year. And they had more, effect than a client I was selling in, Florida, so to speak, where things have been kind of status quo. But I'm not sure I can comment on that. But that's it would be very interesting to look at M&A activity regionally.
Yeah, and we did have a follow-up on our commentary about A, B, and C assets. Could you elaborate a little bit on what you're calling an A asset? Maybe describe to the listeners what we all kind of view as that. We're always talking about the management team's quality of financial information. Could you talk about what you're calling an A asset versus a B and C? Yeah,
for sure. And again, very industry specific, but it's likely a business that is in a market that's growing. So it's got some sort of secular growth dynamics. They've got strong market position, strong intellectual property, depending on what industry it's in. Strong trends too. Both strategics and private equity are extremely focused on trends. So businesses that not only performed well during the pandemic year, but businesses that showed sequential growth in revenue and profitability and are not very capital intensive too. So a lot of that profitability actually results in cash flow in the bottom line. It depends. It depends, a little bit too. From a private equity perspective, it's probably all those things I just mentioned. If you're a strategic, obviously, kind of beauty's in the eye of the beholder, so to speak.
No, I think that's fair. When I'm going through the transaction readiness process, what I usually talk about is, do you have a solid management team? How clean are your financials? Have you been audited? Have you done acquisitions successfully and integrated? When you kind of look through all the opportunities that you would typically be pointing to as an M&A advisor, if you're checking off those boxes, I usually say that's going to be kind of your case study for an A asset if it's an attractive industry. But that's not always the case, right? Each deal is specific. As much as that's a cliche, every deal is different.
It's so true. Anything else, Joe, on the Q&A list, or should we keep rolling?
I think we can move to the next. We have a number of other things that have come in here that we'll chip away at. I think we're going to check off some of these as we get into the outlook.
Okay, that sounds good. And I'll go relatively quick on this slide so we can get to the outlook. But just rounding out what we're seeing in deals, some of this is probably so obvious, but things that, it was just good to see the validation. So as you think about the back half of, the deal, what are we seeing in terms of days of exclusivity? We actually saw a reversion of a trend, which was towards shorter and shorter and shorter exclusivity. We actually saw a very significant increase in exclusivity. Obviously that's in part because many of the processes were, bilateral discussions or outreach to 5 to 10, buyers, so to speak. But we did see, almost half our deals had 45 days or more of exclusivity. That's on the heels of a year in 2019, where the significant majority of our deals had 30 days or less of exclusivity. I think it's also in part just a result of the environment we're in, which is, more challenging to get, financing for deals and to complete due diligence in an entirely virtual manner. On the right-hand side of the page, we have seen rep and warranty insurance continue to be ubiquitous. The availability of these policies did not take a step back during the pandemic. And not only are private equity groups using this, but most corporate strategics are also comfortable using rep and warranty insurance. We saw it in all private equity deals and all deals that we worked on above $100 million. We've also seen it creep down to deals, even under $20 million in purchase price. And then in the bottom right, all but one of our clients last year did a quality of earnings. And I think the one who didn't probably regretted that decision, but we've seen quality of earnings become ubiquitous. And then the last on the bottom left, just not surprisingly, given the challenges around predicting business performance, in the pandemic and with longer exclusivity comes, potential repricings. So we did see a small step up in the number of deals. I should have shown it the other way because I do think it's impressive that, only about 20 or 25% of our clients after going through due diligence had any sort of, repricing. But I do just point out that just given longer exclusivity and challenges predicting business, we did see some pressure on deal pricing. Okay. Anything you want to add there? Good.
I think we're good here. We did have a couple of questions that I think would be good to talk about here. Sure. One, are values that you're showing net of any operating cash or net adjustments for cash-free, debt-free transactions? So are you seeing anything where you're having to keep some cash in the business to help fund normalize working capital going forward?
In competitive auction situations with a banker involved, no. Deals are still conducted cash-free, debt-free with normalized working capital, so to speak. No, I'm definitely not seeing that. I think the only debt-like item, and I'm sure, Joe, you can attest to this, that we've seen horse trading over in this last year is the PPP loans and how those get handled. But we're not usually seeing, cash being left in the business. unless it relates to, an asset account that's almost debt-like in nature, like a customer deposit or something like that, but not usually.
Okay. And then just any quick commentary on the sub-debt markets?
Still very strong, all things considered. Many of the mezz lenders really pulled back, and they were out of service for a longer period of time than the senior lenders or the asset-backed lenders. They have come back. It just took a long time for them to really get their head screwed on straight, so to speak. But the mezz markets are back. I will say that if you look at, the two options, which are a senior plus sub versus a unitranche solution, we continue to see that, unitranche solution gaining relative market share. But the mezz lenders are definitely out there, and they're certainly being constructive for private equity groups looking at deals.
Great. Thanks, Ben.
All right. So now what everyone's been waiting for, the outlook. So we'll give you some insight into what our crystal ball holds. I believe that 2020 will be shaped by a number of different things. I think the thing that's at the top of everyone's mind is, what is the federal government going to be doing? So we'll talk a little bit about tax policies, tax implications, and perspectives on just regulatory frameworks. We'll talk a little bit about ESG, or what's known as sustainable investing. We've seen huge premiums paid for businesses that fit this sustainable, mold. Never has the voice of, stakeholders in a business been louder. And then lastly is just disruptive, technology. The pace of innovation and change in many old line sectors is going so fast that I think you'll see, again, a huge disparity between, businesses that are on the right side of that change versus businesses that are, at risk of having some consequence as a result of that change. So let's focus first on the demand side of the M&A equation. So what is going to bolster valuations and interest from a demand side of the equation? First off, private equity firms have raised record amounts of commitments over the last few years. We're at an all-time high. As mentioned, over $700 billion of capital has been committed, meaning they don't need to go out there and get it. It's already there. That translates into nearly $1.5 trillion worth of buying power just for US-based private equity groups. Second is there's record levels of cash on balance sheets, and there's very low interest rates that don't show signs of going much higher. What does that mean? From the corporate perspective, it means that they've moved well beyond any sort of liquidity concerns that existed at the onset of COVID-19. And now they're actually under pressure to either use their cash on hand or dividend it out. And if you're going to use it, it's a lot easier to use the cash to fund M&A than it is to fund organic growth. From the private equity side, we are seeing just huge demand in the debt markets to support private equity deals. And as mentioned earlier in the discussion, in virtually all industries, the debt markets are back to where they were pre-pandemic. And then lastly is just with respect to SPACs. So for so long, similar to divestiture, SPAC was a very dirty word in the finance community, but now they're used as a very clever backdoor to take companies public. It's a totally new, different way to go public, and it's a much shorter process than a typical IPO. And nearly $500 billion have been raised to support these types of vehicles across 240 issuances last year. It's just absolutely incredible in terms of activity. It's like every day you're hearing about a new electric vehicle spec that's that's pricing in the market. I don't know where these keep coming from.
What's been your view
I
of
do
that?
think from the demand side, these are the three things that are going to keep valuations lofty.
And what's been your view of the SPACs? You know, I think I've used it and described it as the new shiny toy, because last year was direct listings. This year it's the SPAC. They have 2 years to put those funds to use. You know, I think we finally heard our first, whether it's negative or not, but first issue there where there's been some question over some of the regulatory disclosures of kickbacks and things like that weren't disclosed on one of the recent SPACs. What's your view of the SPAC and kind of long-term outlook?
Yeah, my view is that it's very much shifted, and there's certain SPACs that I do believe are being used, very legitimately to fund, actual businesses, and I certainly think that that's just clever. It's just okay. Instead of going through the full IPO process, which involves lengthy S1 preparation and a roadshow, let's just go to market through a blank check company that's already been listed. On the flip side, you're hearing stories like today. There was I think it was an autonomous flying vehicle company that's expected to have 100 million of revenue in 2026, right? Then you hear about these things that are more concept IPOs, so to speak. And I think those are the types of situations that give me some pause with respect to the sustainability. I do think SPACs have a place and a use. I think they're very niche in terms of their application. I do view them as kind of the soup du jour. From my perspective, it's like, well, you got to have them in the pitch book because every other bank is, but I really don't think that their application is ever going to be widespread.
I think that's fair.
So just quickly, so we talked about the demand side. On the supply side, I do think there are going to be a very large backlog of transactions from pre-COVID. Interestingly, over half the deals that our team did last year were actually mandated after COVID began, not commenced pre-COVID. So there's still a huge number of deals that we and other investment banks are mandated on that have a time and place to be completed. In 2021 might be that year. The second is just new deals coming to market. And I think the major trend there is pent-up demand for private company sellers looking for liquidity events, largely because of potential tax changes that will happen. And we'll talk a little bit more about what those are. As mentioned, these are things that we're tracking very closely in our market. These are key developments that could have a huge impact one way or the other. Again, we're talking about private company M&A. So the corporate tax rate doesn't necessarily have direct consequence because most of our clients are pass-through entities. But many of the buyers are C Corps. So for buyers looking at deals, any sort of increase in tax is going to take money away from, dividends or reinvestment in their own business or acquisitions. So it could put a damper on strategic engagement in deals. From a capital gains perspective, which is how most of the profits in deals are treated today, the capital gains rates for high income earners might go up all the way to ordinary income. I guess we'll see. And if that's the case, and if the tax law is not going to be retroactive, I do suspect there will be a race to the exits in 2021. In terms of regulatory, pressure, it's going to be very industry specific. We highlighted here healthcare, but there's other industries as well. And then there's also particular concerns about foreign acquirers from certain countries. you're already seeing some pressure from an HSR perspective, which is the Hart-Scott-Rodino perspective. The federal government suspended, early termination, so to speak. So they're not even doing that right now. So you're already seeing them take steps to really kind of rein in the regulatory approval process for deals. And then from a foreign perspective, I do suspect CFIUS reviews will take longer than they have historically. And then with respect to COVID-19, this is the real, wild card. No one necessarily knows where the world is heading. Based on how the stock market's performing, I think you'd think the world is completely back to normal. The reality is that it isn't. It's completely outside our control. But ultimately, if for whatever reason there's a new variant, or if for whatever reason the vaccine rollout slower than expected, that'll provide some sort of damper on M&A activity naturally. But those are things we're tracking closely.
And we've heard a little bit more about the Stop Wall Street Looting Act. And, it started about a year ago. Now we're hearing it more again. Can you talk a little bit about what impact that may have, as well as what are the chances that, there may be an elimination of a step up in basis for 21 or 22?
Well, I've got to tell you, on any changes to tax policy, your guess is about as good as mine. I do think, on the heels of, $1 trillion being spent earlier this year, another $2 trillion, inevitably taxes are going to increase one way or another. The question is, how much and when. With respect to, other sorts of regulatory, oversight of, banks and other regulators, I really can't comment, but I think inevitably there's going to be a tax increase. My guess is that it will be, over time, not necessarily all at once, to try to soften the blow to the system, so to speak.
Yeah, I think that if you look at kind of precedents and what other administrations have done, that seems to be pretty supportive of what we've seen in the past, right?
Yeah.
So I know we only have a couple minutes left here, but we're actually down to just a few questions left. We'll see if we can check off these last few real quickly. You've touched on some of this already, and just anything that you think is really ripe for M&A activity as far as industries go?
So, I can speak to the industries that I cover, very specifically. We've seen huge interest in all sorts of specialty industrial companies. Packaging has been very hot, particularly on the heels of growth in e-commerce, so to speak. Packaging has been really hot, especially in certain end markets. Chemicals have been very attractive too. Businesses, again, that are very highly specialized have done very well in this market. But yeah, there's a whole host of industries that are attractive. Businesses that are either highly differentiated and have competitive moats around them, or ones that are highly fragmented that could be used as a vehicle for a roll up. I think those are kind of the two foundational characteristics.
Okay, I think that's helpful. For me, I've been looking at a lot of anything with automation or digitization at this point. If they've done a good job of that, they've been usually trading pretty well. Technology, healthcare, things like that have been done very well right now. I know we're here at the end of time, so I want to be mindful of everyone's time that's on. We had a couple questions that are still remaining that, we're more than happy to do some direct follow-up related to these, but I'll turn it back to Kelly for wrap-up.
I'm sorry about that, Joe. Can you hear me?
Yep, we can hear you.
All right. Sorry, I'm having some technical issues with my mic. This marks the end of our session. Thank you for joining us today. We look forward to you joining us on future sessions. You can find out more information about upcoming webinars in our resources box. We do apologize for the technical issues in regards to the polling and CPE attendance checks. CPE will be sent via email within the next 48 to 72 hours. If you have any questions regarding CPE credits, please email conf@financialexecutives.org. Have a wonderful day. And again, thank you to our speakers for today's session.